There's a woman in Ohio checking her pension statement online. 63 years old, 31 years at the same company. The number on the screen says she's on track. 7% return last year, diversified, professionally managed. She closes the laptop. Feels fine. What she doesn't know is that part of her retirement, the part labelled alternative investments, has been lent to companies that are paying their interest by borrowing more.
$1.7 trillion. That's the size of the private credit market right now, larger than the subprime mortgage market was in 2007.
1.7 trillion. And almost nobody outside of Wall Street knows it exists. This is Chapter 3 of The Great Repricing. In Chapter 1, we traced how a naval blockade in the Strait of Hormuz repriced oil, shipping, and insurance. In Chapter 2, we traced how the same blockade cut off fertilizer and how fires, drought, and disease are repricing your food. Now the chain goes deeper because the same Hormuz crisis that's keeping energy expensive is keeping interest rates high. And high interest rates are silently breaking a $1.7 trillion pool of loans that your pension is sitting inside. Energy repriced your fuel, food repriced your kitchen. Now the financial plumbing is repricing your retirement. Same chain, same origin, new organ. Here's what private credit is in plain language. Banks used to lend money to companies. Now increasingly, private funds do. They raise money from pension funds, insurance companies, sovereign wealth funds, and, in the last few years, from people like you, through vehicles you've probably never heard of called BDCs. These funds lend to mid-sized companies. The loans pay high interest, 8, 9, 10%. Sounds great on a pension statement. But here's where it gets strange.
The default rate on these loans has reached 9.2%. That's Fitch data. The historical average is 2 to 2.5, and 60% of those defaults aren't traditional missed payments. According to Fitch, 60% are PIK conversions and interest deferrals. The company isn't paying cash. It's paying by borrowing more.
Let that land. The company owes you interest. Instead of paying you, it adds the interest to what it already owes. Your statement says performing. The reality says compounding. It gets worse. And this is the part that should concern anyone with a pension. The loans are valued based on models, not markets. Unlike a stock where the price is set every second by buyers and sellers, these loans are marked by the lender. They decide what it's worth.
UBP calls this the phantom cushion. The equity that's supposed to protect your loan is based on valuations from 2021 and 2022. Public market multiples for the same type of companies have compressed 25 to 30% since then. That's observable data. The private marks have barely moved. The cushion may already be gone, but nobody has updated the number.
So the woman in Ohio sees a 7% return, but the assets underneath that number haven't been honestly priced in 2 years. The protection she thinks she has might be an illusion, and she has no way to know. Now add interest rates. Most of these loans are floating rate. When the borrower took the loan in 2021, rates were near zero. Now they're above 3.5%.
This is the mechanical vulnerability. And it's in the UBP research. A company with $50 million in earnings and $275 million in floating rate debt had a comfortable coverage ratio of 3 to 1 when rates were at 1%. At 5%, same company, same revenues, same customers, nothing changed. Coverage drops to 1.6. Covenant trigger territory. The credit impairs through the rate mechanism, not through the business failing.
The business is fine. The loan isn't. And here's where the great repricing reaches the boardroom. The Fed can't cut rates. Why? Because Hormuz is keeping energy at $95 a barrel. Because the fertilizer shortage is about to push food prices 15 to 20% higher by October. Because CPI can't cool when the physical inputs are all on fire. So the very same choke point that made your petrol expensive and your Dow expensive is now making these loans impossible to service. The chain didn't stop at your kitchen. It kept going, through the rate mechanism, straight into the financial system. That's not a coincidence. That's a chain. This is where it gets dangerous. The companies behind these loans are backed by private equity sponsors. The sponsor put up equity, 30, 40%. As long as that equity is worth something, the sponsor supports the company, injects cash, cures covenants, keeps the loan performing. But the sponsor is rational. They're doing math. And the moment the math says the next dollar of support is worth less than what they'd recover by walking away,
they exercise the put. That's the Merton model applied to sponsor behavior. The sponsor walks. The loan goes from performing to non-accrual in a single quarter, 90 days. The economic deterioration happened over 18 months, masked by sponsor support the entire time.
90 days, performing to impaired. Not gradually, a cliff. The woman in Ohio won't see it coming. Her statement will say on track the quarter before and lost the quarter after, with nothing in between. And now the part that echoes 2008.
80% of listed BDCs are already trading below their stated value. Bloomberg data, several at 50% discount. Blackstone's largest credit fund saw $3.7 billion in redemptions in a single quarter, a record per Bloomberg. Moody's revised the entire BDC sector to negative on April 7th. Each forced sale drives values lower, which triggers more selling. The spiral is self-reinforcing.
$3.7 billion pulled from one fund in one quarter, and Blackstone is the strongest name in the business. In 2008, the trigger was a housing market. The vehicle was the CDO. The opacity was the credit rating. Today, the trigger is floating rates plus sponsor walkaways. The vehicle is the BDC. The opacity is the model-based mark, 1.7 trillion, versus 1.3 trillion in subprime. Bigger. Think about what we've shown you across 3 chapters. A naval blockade closes a strait, oil reprices, fertilizer reprices, shipping reprices, insurance reprices. Your fuel goes up, your food goes up. But the blockade also keeps inflation sticky. Sticky inflation keeps rates high. High rates crush loan coverage. Crushed coverage triggers cliff defaults. Cliff defaults break lending vehicles. Broken vehicles pull money from pension funds. Pension funds pull money from emerging markets. Currencies weaken. Imports get more expensive. Inflation gets stickier. It's a loop. And it started with ships that stopped moving through a strait.
One choke point. 13 chains, 3 chapters, and the same origin point connecting the price of Dal in Mumbai to the pension statement in Ohio to the factory floor in Guadalajara. That is what a repricing looks like when it reaches every layer of the system.
If you have a pension in the US, the UK, Canada, Brazil, India, anywhere, part of your retirement is likely inside this pool. It's in the alternatives bucket. It says it's returning 7-8%. It might be, or it might be returning paper gains backed by paper promises. If you work for a company backed by private equity, and millions of people do, from IT firms in Bangalore to maquiladoras in Guadalajara to healthcare platforms in Ohio, your employer's survival depends on a sponsor's math. When the math turns, the sponsor walks. Your job is the collateral. If you hold currency in an emerging market, rupee, real, peso, rupiah, and global capital tightens because pension funds are pulling money home to cover losses, your currency weakens, not because of anything your country did, because of loans that went bad in Connecticut. The Great Repricing didn't stop at energy. It didn't stop at food. It's inside the financial plumbing now, and it started with the same ships in the same strait that we've been tracking since day one. We see the chain, end to end, from the choke point to your pension statement. Before the downgrade, before the headline, before the loss. What does your pension invest in? Check the alternatives line, then come back and tell us. We read every comment, subscribe, because this chain isn't finished.